Hey y'all, I'm Laura Richardson with Relevate, and we are bringing you another episode of our podcast. And today we're going to be talking about mortgages and financing. This is some of the most important thing that you need to think about before you buy a home. You got to have money in order to make that big purchase. So how do you get the process started? What are the different types of mortgages? What is a mortgage? These are all some of the top questions that we get asked, and we are bringing you the answers. So first of all, what is a mortgage and how do I even get one? So you have to understand that there are two different categories here that we're going to be talking about. But basically, a mortgage is a loan that's offered by a bank or some kind of lender, and it lets you borrow money to purchase a home or land in some cases. And then you get to repay that over time with some interest. That interest rate, and one of the big things that you guys hear about in the media, that is that interest rate that we're talking about, okay? So you have the total of the home plus that interest rate. So you have that principal and interest. So there are 30-year fixed mortgages. There are a lot of different types of mortgages, and we're going to get into the nitty-gritty on that. But your mortgage is basically including that down payment, personal finances, government policies, all of that stuff comes into deciding what you're approved for. So think about it like this. If you have a very high debt to income ratio, meaning you owe a lot of money for other things already, you may not be approved for a substantial amount for your home. So you want to have a very low debt to income ratio if at all possible. Or you need to use a mortgage product that matches a little bit more with that debt to income ratio. But all of these things, like that amount of down payment, all the personal finance stuff, so like credit score, income, the debt to income ratio, all of that's going to mess with what you are approved for, and then also the rate that you're given. All right, so what types of loans are there? Well, there are a couple different factors that can determine what's available for you, but there are two categories, like I was saying earlier. You have fixed rate mortgages, which are usually 15-year or 30-year, meaning that during the duration of that time, the rate does not change. And we're talking about your interest rate here. So there's another category called an adjustable rate mortgage. We typically refer to these as ARMs, and they have a different set of periods. So 5 years, 7 years, 10 years. So that means after that time period, the rate can change. So if you're thinking about which one of these is the best option for me, there's a couple of variations that can kind of help you figure this out. First of all, how long do you plan to be in the home? If you plan to be in it for a really long period of time, having a fixed rate might be a better option. But if you're planning to be in that for maybe only 5 years or less, an ARM may not be a bad product. Also, in some cases, the ARM rates are going to be better than the longer term rates. So there can be a couple of reasons why you choose one versus the other. But as always, make sure you talk to your lender about this. They're going to give you the most up-to-date and best intel in order to make that choice. So one of the other big questions we get is, what is a down payment and how much is that going to be? So let's say that you're buying a $300,000 home. Your down payment is going to be a percentage of that total. So let's say that it's a 20% down payment. This is what we like to call an 80-20 loan. So 80% is in the loan, 20% is in the down payment. That amount is going to be $60,000 because it's 20% of the total purchase price of that $300,000 home you want. So for some folks, that $60,000 in down payment is just not doable. So that's why you see that sliding scale of maybe they're only putting 5% down, which would be $15,000. This is where, guys, remember how you were sitting in math class, maybe in 8th grade, and you were thinking, when will this ever apply to me? This is when you're buying a home, all of a sudden, a lot of these statistic skills are going to come back into play. So another thing to understand about a down payment is there is a stereotype that you have to have 20% in order to buy a home. That is not true. The reason that the 20% is one of those top of mind topics is because if you put down the 20%, you remove something called PMI, that private mortgage insurance. Again, ask your lender about this and whether or not that's the right option for you. In some cases, you may only have to put down a very small percentage of down payment because your loan product only requires a certain amount. There are certain types of loans like physicians loans, VA loans that actually allow you to put as little as 0% down, meaning you literally don't have a down payment when you buy that property. So, what's the difference between conventional and federal home loans? Well, conventional are privately backed. So, think about it like a private lender is a bank, a credit union, or some kind of mortgage company. Now, the federal loans, government backed loans, are typically your like VA loans, FHA, USDA. So, the lender is actually carrying a little less risk and kind of can pass the savings on to the eligible borrowers. So, your FHA loan is something through the Federal Housing Administration. Obviously, your VA loan is for your veterans. And then you also have a loan product like the USDA loan that's typically used more in rural areas. There's actually a map you have to utilize to make sure the home qualifies. But each of these are great loan products that allow you to put less of a down payment on the line. And those government-backed loans are very secure. So it's a great opportunity. So another big question we get is, are there any other ways that you can lower your out-of-pocket costs? So you've got your down payment. There's another category called closing costs. So this is something like paying for your attorney fees, your title search. There's a lot of stuff like property taxes. They all kind of fall into this category. Typically, it's about 3% of the total of the purchase price of the home. So going back to the model we use, that $300,000 house, let's just assume it's about $9,000 to $10,000. Where can you get those funds? Well, that's where something like seller concessions can come into play. You might be able in your contract to ask the seller to pay for some of those closing costs. Now, keep in mind, there is a cap. Typically with conventional loans, it's around 3%. And then with some other loan products, it might be 6%, meaning you can't just say, I want you to pay $100,000 of that $300,000 purchase price. That's not the way it works. There are maxes that you can get based on the purchase price and the type of loan that you're using. So this is another great thing to talk to your loan officer about. What is the maximum cap that I can get when it comes to seller paid concessions? It's really crucial that you know this before you put in a contract, because that's something that has to be agreed upon up front. The other opportunity is obviously through due diligence repairs negotiations. Sometimes some concessions can come into play, but that is definitely not a guarantee. And you probably want to know about those liquidated assets way in advance. It may actually determine whether or not that's the home for you and whether or not you're eligible to buy. So when you're talking to your mortgage loan officer, make sure that you're asking about the down payment amount, the different types of loan products, and then the out-of-pocket expenditures and how you can keep as much as possible in your pocket for that rainy day or the DIY projects that you have coming down the pike. Again, I'm Laura Richardson with Relevate. Be sure to check out some of our other videos that are going to help you with buying your new home. We'll see you next time.